Gentlemen, and thank you very much for coming here today, this evening. This is my second year of partnering with Mehta FinCon for the investor conference, and let me tell you that ET now is, privileged to be partnering with you guys. And in fact, Mehta FinCon as a company helping investors here, hundreds and dozens of investors, is doing a phenomenal job because after all, it's just not business for them to help people invest. It's also about helping them understand the business of investing. It's a complicated subject, and that is why year after year, they are taking efforts to bring some of the, people who've been around long time, institutions which are into the business at a very larger scale, their resources, so that you guys over here can become better investors. In fact, Indians, all of them, most of them, have been for decades now people who love to save. But when it comes to investing, they've stuck around only with real estate and gold. And clearly now with the environment changing so much, I think it's all the more important to have various other kind of investment options, to learn more about them, how to increase your yields better over a period of time. And that's what the job of Mehta FinCon and partners like these is today. And we at ET now are proud to be partners of Mehta FinCon family. So let's have a big round of applause for the efforts they are taking for you guys to become better investors. Great. So let's kick off the evening then with my friend David here. David, first of all, this is your first time in Surat, right?
This is my second time in Surat. I'm glad to be back.
Great. So, the hall is almost full, 90% full right now. What is your assessment? So many people over here are here to listen to you guys. They seem very interested into the, learning more about investing. How do you compare it? You've traveled many cities in India in the last 2-3 years. What do you make of it?
I think it's very exciting. It's always fun to see the Indian enthusiasm, the Indian sophistication as they approach a global market.
Great. So why don't we do one thing? First, let's listen to your presentation. Today, David is going to talk about the importance of diversifying your investment across the country. How does the stability of dollar as a currency come in handy? And some other important points which investors should take into account when they are managing their portfolios over a prolonged period of time to make wealth generation. So let's have your presentation first.
Very good. Great. Thank you all for the warm invitation and certainly the warm reception that we've gotten here on behalf of our CEO, Stan Bradshaw, and myself. This is my second trip back to Surat, to maybe my 10th or 12th trip maybe to Gujarat. Always enjoy coming back to this area, coming back to India, and the warm reception we receive. Thank you to Mehta FinCon for the opportunity to bring what we do to you. The Global Investor Conference, I think, is a great opportunity for Indians to learn about opportunities outside of India. Many of you have family that's traveled outside, many to the United States, but an opportunity to learn about the investments and the investment styles that are available there. Over the last 2.5 years that I've been coming to India on a regular basis, we've seen a tremendous increase in the sophistication of the investments that you have available domestically, as well as the sophistication as you learn about new opportunities that are available outside of your borders. Briefly about U.S. Freedom Capital, the company was founded in 2011, so we're 6 years old now. We've got a little over $280 million US invested since 2013. And our company is focused on U.S. opportunities for global investors. We have securities licenses and compliance in multiple places, but primarily the United States, with oversight of the SEC, which is our version of SEBI, personal securities licenses, company securities licenses. So The difficult part of being an investor is the future. And the thing that impressed us when we came to India was that Indians were primarily balance sheet investors. They were investing for wealth, generational wealth. And you see assets like gold and land and property, and those are great investments, and Indians have done very, very, very well doing that. But some of the challenges with that is they don't generally generate significant income, and at the time when you need liquidity most is the time when they are least available to you. And so many of you, I'm sure, have seen your friends, your relatives who have invested in property, and the time came when you needed cash from child's education or a medical emergency or for whatever reason. Everyone needs cash from time to time, and the time was not right to liquidate your investments. And so one of the things that we attempt to do as part of a larger investment strategy is to invest for all times in life. Sometimes the stock market is good, sometimes it's not. But by creating a venue and a platform that gives us the ability to anticipate the future, we can be less reactive and we can be more strategic in our investments. So to give you an idea of that, everyone knows Yale University, I'm sure. Yale has an endowment of $30 billion. And Yale, maybe if we could draw some parallels to your own family, is investing for the future. Yale is not worried about making 15 or 20% in the stock market this year. They have a much longer view. And if you take that longer term view and look at their portfolio and how they invest, less than 25% of Yale's endowment is invested in our equities market or in world equities market. But it is focused on wealth maintenance and wealth creation. And for a university, obviously, then they can use those funds for programs, planning, expansion, and such. But the primary driver is don't lose money. Don't lose money. And so being diversified is a way to help us, help them, avoid the troughs in the market. So in the United States, real estate is a bit different in the way that we invest, in the way that it's been described to me here. Investment in India primarily is long-term appreciation. You buy low. Real estate in India always goes up because there's a huge demand and no one's making more land. And therefore, the perception has been real estate has been a ever-increasing wealth creator. That's great. That's true. In the United States, we have the public markets that have created more interest in the cash flows that real estate generates. So if you think less about real estate being an asset in itself and rather a vehicle to create cash flows, if you're a landlord and you collect rents, that's the cash flow from real estate, then that cash flow in the United States many times has more value than the real estate itself. So while you could invest for appreciation, in the United States, we at the institutional level generally do not. And what does that mean for us? It means that a predictable and stable source of cash flows that comes off a property is worth more than the property itself. And so fixed income assets are the primary driver of U.S. commercial real estate. So I want to take you through a case study of an investment that we've made in the United States. It's been very successful, just to help you understand how that works. Oh, sorry. So the Parkgate portfolio is a portfolio of healthcare facilities that is located in Texas and Oklahoma, so the southern United States. And there's 6 facilities out of a portfolio of 36 by a single operator. This operator has a significant amount of equity trapped in that portfolio. And rather than go borrow money that pays, they'd have to pay high interest rates, or go dilute their equity by bringing in a partner to bring in new capital, we help them structure a transaction that freed up the capital that was already trapped in their real estate. So their goal, out of a $72 million portfolio, is how do they free the equity that's trapped inside? So the financing structure that we used, they had a mortgage. Some of you have mortgages on your properties. But the way that we've built the financing here is we've brought in another piece of capital. So on the column on the left, they're currently paying 5.7% for their cost of capital. 6.5% is what they pay for us for the 3 years during which time they're using our capital, and that gives them a 40-year benefit on the backside. People many times ask us, how do we generate the 8% returns per annum that we pay to our investors? Because we are using a more complicated structure. We do significant amount of underwriting to make sure that the investment is proper and well-suited. These are existing cash-flowing properties. They have a track record. They have audited financial results. And as a result, we make sure that the ability to pay is there. I won't take you through the details of the underwriting. Collateral is very important to us. And in this case, in the Parkgate portfolio, we have collateral that is 8 times the value of the investment that's made. So again, safety and security of the financing is of primary importance. And so what would you do if you could make 8% per annum from an investment? What does that mean to you personally? And so the fund that we have that is set up for education purposes could go something like this. And I'll take you from left to right. If your child was headed to the United States or the UK or Australia for education, you know when that's going to happen. If they're an IB school, you can predict 3, 5, 7 years out and begin financially planning for a significant financial event in your life. In the case of our fund, generating 8% returns and starting 3 years in advance. So if we start in 2018 and fund, I'm at the top green line, fund $100,000 a year for 3 years, and that investment is making 8% per annum. By the time 2021 comes across and your child is ready to go to school, you've accumulated $48,000 worth of interest at the fund. Now, we've used $220,000 as the cost of a U.S. education divided by 4 years, so $55,000 a year. Well, we're generating $24,000 a year in interest. So at the end of this period, you've invested $314,000. Your return on investment is 38% over that period of time, and your net cost of education went from $220,000 to $82,000. That's the power of what 8% per annum returns can do. And they're fixed returns. We're not predicting that the equities market is going to generate a 38% return over 7 years. We're not predicting that your child will be able to afford an education. These are fixed, established, stable returns backed by historical cash flows, backed by massive amounts of collateral. So in our case, real estate is about generating very predictable baseline for your investment. And by no means should this be all of your investment. In the United States, we refer to real estate and non-equities, non-bonds as alternative investments, and a wealth manager would probably suggest to you that that's less than 20% of your portfolio. This is a small part of it. But what it does is provides a nice stable baseline of income over time that sure, in boom years, you're not making 25 or 30% in the stock market. But in the down years, you're not losing 35% either. And so that stability allows you to sleep at night, gives you that stability. So that's what I have for you today. I would add, my time is up. I'd love to share more with you. But if you took the 8% fund that we have and you made an investment at $1 million, then that investment would qualify your child for a U.S. green card without any sponsorship, no employment, no employer, no sponsorship. They'd be free to stay in the U.S. They'd be free to travel as an American. 5 years later, eligible for citizenship. So be pleased to discuss that with any of our staff as we go. And thank you very much for your time.
Thank you very much, David, for that presentation.
I request you all to please keep your phones on silent mode. I request you all to please keep your phones on silent mode. Thank you.
Great. So David, just to break it down once again, for the benefit of you, our guests who have just come in, it's a packed house now, I must say. The curiosity for knowledge of investments is very high. What you're saying is that for HNIs and ultra HNIs, essentially the kind of people which are attending the conference today, there is a strong case building why one should also have one slice of the portfolio beyond only our own country, beyond only where the underlying is the rupee. So currency and country diversification is essential and meaningfully can be a strong case for. Can you explain a little more on the concept basis?
Sure. The rupee has historically depreciated against the dollar, and over the last year or so, there's been significant rupee strength. But if you go back to the RBI's prediction, I think you continue to expect to see dollar strength going forward. And the math bears that out. The advantage being, if you were to put some of your, again, we're talking about an alternative investment, but if you were to put some of your investment into dollars, and there is a depreciation of the rupee against the dollar, that is in itself a return. And the currency, the foreign exchange is an alternative investment, even before you get to the kind of stable returns that we described.
Clearly. So the data shows that 5% annual depreciation of currency versus the dollar for the last 30 years has happened. So that get arrested. Talk to us a little bit about if an investor over here actually considers investing with Freedom Capital and looking at whatever the scheme details are, what kind of net returns would that slice of the portfolio make over a 3-5 year basis? And also I would emphasize on the point net returns, because I've observed that Indian investors usually focus more on gross returns when they're analyzing various asset class, FD, fixed income via FD, or real estate, approximate, or equities. So why is the difference between net and gross high?
Certainly, and so as we drive around and we see the billboards from the banks offering FD at 6.5 or 7%, that's a gross return. And inflation is a tax on returns, and it reduces the advertised rate to a real and effective rate. India, as an emerging economy, has higher inflation than the established economies. And so when you look at U.S. Interest rates that we earn on our fixed deposits, they are roughly in line with, on a net basis, what Indians' return is on a net basis. So if you take your 6.5% gross return that FD offers and you subtract the Indian rate of inflation of 5.25%, you have a net return of 1.25%. Inflation is always a tax. And so whenever we describe returns, gross returns to us are unimportant. I could deliver 40% gross returns to you, but if it costs 39% to get there and your effective rate is 1, what have you achieved at the end of the day? 1%. And so net returns is the sole measure that we use.
Mm-hmm. Okay, my last question to you would be, investing in the products of Freedom Capital, not only you are talking about indicative returns of 8% net, plus a steadier currency, of course, the underlying, but there's also an added advantage of getting a green card / PR over there, which I'm sure, clearly we are sitting today in Surat, in Gujarat, which is the highest number of, immigrants in US actually from Gujarat, second to perhaps Punjab. So there's already eagerness to go there, right? And that is also an added advantage in the product.
It is available, yes, for sure. And we're primarily an investment house first. But for us, when we took our investment product and just modified it a little bit, we can meet the requirements of the U.S. Immigration Service so that it qualifies for a green card as well. That's not our primary goal as investment managers, and we would never recommend an investment product that was structured solely for immigration. That probably means it's a less quality financial.
No, I was asking you also because there is also eagerness to send your wards, your children, for higher education to all parts of the world, especially US. So that also, how does it fit in?
So the green card that we're offering is under the EB-5 Investor Visa Program. So the U.S. has 3 primary routes to a green card. The first is family reunification. So plenty of people that we know are stuck on a 10 and 15 and 20-year wait list for their auntie to sponsor them to get to the U.S. And it's just the demand overwhelms the supply. President Trump has very clearly come out and said that family chain migration, that multiple levels of immigrants being sponsored is something that he is going to attempt to change. On the second case is to high-skilled workers, right? The H-1B program that everyone is familiar with. That again is under fire. And the U.S. long-term has to have immigrants. We have our unemployment rate where we live in Dallas, Texas is 3.1%. There's simply not enough people to do the work. But what the U.S. is looking for are the high-skilled people, and there will always be some amount of path for that. But the investor visa, where you are a passive investor, and HNI is not interested in being someone's employee to get a green card. The passive investor visa is one of the few routes that are available, and that's why we chose that model to structure our product around.
All right, David, thank you very much for your time coming down today and attending this conference.
Thank you.
Akanksha, back to you.